Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger and Associates Financial Planning. This is a sort of an impromptu episode that we're throwing out here. It actually comes on the heels of 3 consecutive episodes that we had with Thomas Bayless, a CFA, the owner and founder of Cornerstone Portfolio Research. But what we're doing today is I'd like to introduce Brad Sorensen, also a CFA, Chartered Financial Analyst from Cornerstone. Brad, thank you for joining us today.
Great to be here, Mike. Thanks for having me.
You bet. So what we're doing here is over the course of the last weekend, and I should point out, as I did with the episodes that we did with Thomas, your fearless leader, I'm pointing out that today is Wednesday, August 7th, because as we know, especially from last weekend, things can change rather quickly. And by the time this airs, it might not be until Friday. And God only knows what could happen in the next day or two to make what we're talking about today stale. But the main purpose of today is to kind of talk about what happened last weekend. So for instance, we saw a fairly precipitous drop in the markets on Thursday and Friday of last week, which, back it up, on Wednesday was when the Fed came out and chose not to raise interest rates. And the markets basically didn't react one way or the other because they expected it. But then all of a sudden, data came out. Markets dropped on Thursday and Friday, not huge amounts, but enough, 1%. And then over the weekend, something happened. And then Monday, globally, the markets were down. And it kind of annoys me a little bit when we watch the media, how they report it, okay? Some of them are reporting it from a political spin, the Kamala crash or the Biden crash or whatever. I don't think that's fair to say, just as it's not fair to say the recovery is associated with them either. But we're hearing the R word, recession being thrown around. So, Brad, let's talk about what happened this weekend, which I heard exactly zero of it on the news. And it really was originated by Japan on their Monday, which was our Sunday. Can you talk about it, please?
Yeah, sure. Let's just start with, so the Fed stayed steady. They didn't cut, and that was expected. The market didn't mind. On Wednesday, it was fine. Thursday, we got a little bit of weak data. Friday, the week employment report, that got and it's weaker. It's not weak. That's the one thing to point out. The employment market, like, we still had 115,000 jobs produced, and that's kind of normal. That would keep us growing at a roughly 2% rate, 2.5%, based on historical evidence. So that's not exactly falling off a cliff, or recession is what some people are throwing out there. So the market is getting concerned about economic growth slowing. That's also important. It's growth slowing, not the economy slowing in itself, in that it's contracting. That's not happening. There's no evidence that that's in the near future. The growth rate is slowing, which you would expect after these Fed rate hikes. So then we come to Sunday, and it was overnight here, Sunday night. What happened last week was that the Japanese central bank, we don't really pay attention to it, but they boosted
It's the
interest.
Japanese version of the Fed, right?
Right, exactly. And they've had very, very easy money policy. If you know anything about Japan, they've been fighting deflation for decades, basically. They have a lot of problems. We won't go into those. But they finally raised rates a quarter point. In response to that, the yen spiked, Japanese currency. Well, why do we care about that? Well, the market cared about that because what was a result of that was the Japanese stock market went down 12%. Biggest
That's a lot, by the way, and to
the
put it into
biggest decline
perspective,
since Black Monday. If
right?
anybody
It's the
remembers
equivalent
Black
of the
Monday of
Dow going down.
1987.
It's the equivalent of the Dow going down 5,000 points,
Right.
which is a
So
wake up.
it is a substantial thing, and that is a major market. So that gets investors' attention. So what happened there? Well, it's something called the carry trade was being unwound it to some extent. And I'll try to explain the carry trade. Is funny. I was talking to my wife last night. I said, yeah, I say carry trade, and half the people in the room nod, and I know they don't know what I'm talking about. So that's what the media does. They go, it's the carry trade. I go, that guy has no idea what he's talking about. So a carry trade is basically, it's pretty simple. You could borrow in yen and get a very low rates. So you borrow at very low rates, and then you take that money, carry it over, and invest in dollar denominated assets, stocks, treasuries, mainly real estate if you wanted to. That's not as common, but and you get the higher interest rate. So you play the spread. You don't get the spread on the currency and then the asset appreciation if that happens, but you automatically gain on the spread and the interest rates. So that, as a result of the Japanese central bank happening, raising rates, their borrowing costs went up. And over the past couple of weeks, treasury rates have come down, which was a big beneficiary of the carry trade. So US rates down, Japanese rates up. People had to cover those trades because they were upside down and losing money. And something called, that most investors know, margin calls. Brokerages were making them put up more collateral because their balances were going down. So they had to sell Japanese assets, yen denominated assets, in order to cover that. And that's what accelerated the losses in Japan. Then panic. It's kind of the, then there's concern that it's a bigger problem. So in that case, investors sell now and ask questions later. So investors got out very quickly Monday morning all around the globe.
Well, so there's a chart here that shows the movement of the yen versus the dollar.
I
And
see that spike at the end. That's what really caused it.
so it actually raises a question to me, Brad. We saw the Fed raise interest rates 1/4%, a boatload of times. Was it 17? No, more than that. However many times that they raised the rates between 21 and 22 and into 23. But they're raising it 1/4%, 0.5%, or 0.75% every time. Why did just 1/4% in Japan cause all this mayhem? 1/4% seems to me nothing.
Yeah, I would agree with that in normal situations. But like I said, the Japanese central bank's been fighting deflation for over 20 years, and they've had this zero or below zero interest rate policy that whole time. And so when you come off of, what's the percentage of zero that 25 basis points is? Obviously,
Infinite.
but
Right.
say you're off of 0.001, it's 25,000% that your
Right.
rates. So in the context of that, and it's just that people had, you kind of, it's a, maybe US investors could, it kind of is analogous to what happened with regional banks last year, that they got upside down on their treasury trade after treasuries went up and they had to get collateral and stuff. This was a very concentrated, there were all these bets that there would be a zero interest rate policy forever, basically. And when that didn't happen, it surprised the market and investors, and they had to scramble to cover those trades.
So what you're saying is that unlike the Fed, where the Fed sort of leaks out intentionally hints to what they're going to do, this came as a complete shock to Japanese investors.
Complete, but a pretty big shock. Like there was rumors, but it certainly wasn't like the Fed where they telegraph it months in advance and tell you where they're going, tell you what they're thinking. Japanese bank doesn't really work like that. It's much more close to the vest, and it was a surprise for sure.
Well, not to mention too, do they have a routine like the Fed is every 6 weeks? Do they have a routine central bank meeting schedule, or is this just they popped it and did it?
Now they have set. It's similar to the Fed. They have regularly scheduled meetings, but when you have a regularly scheduled meetings and you haven't done anything in 20 years, you kind of lose a little of the interest. So I don't know that there was, I mean, they still pay attention to it, but they weren't expecting this move, obviously. And I'll just throw out one thing that we'll kind of move on to, that I said the investors sell and ask questions later. Well, now they started to ask questions. Is this a systemic problem? Is this an indication that the financial system is at risk? And it would be naive to think that the central banks don't talk to each other. And it's my opinion, not proven yet. I don't know if we'll ever know because these conversations are pretty under the table. They keep them pretty close to the vest, they don't publicize them. But I am pretty sure that Chairman Powell of the US and the chairman of the Japanese central bank had a conversation about the yen trade getting carried away. That carry trade was getting a little long, it was getting overpopulated, and that could be a risk to the financial system. And they wanted to be able to deflate the balloon before it got too big. And I think they didn't mind seeing this because it unwound some of that and prevented what may have become a systemic problem. We don't have one. There's not one. There's no evidence of one. This was just an unwinding of trades that had become over leveraged and people had got too comfortable with the risk that was involved with this trade.
Ah, so remember I said to you at the beginning that there were a couple questions that I thought of that were brilliant last night, and I forgot them. I remembered them. So specific to this, I do know what happens a lot of times is you have program trading, and you hear that term a lot, and it wouldn't surprise me if that came into play on Monday, or did it not? Again, talk real quick about program trading, and then the second comment that I wanted to bring up is that during the summer, when everybody's at the Hamptons, everybody in New York is at the Hamptons, there's lower trading volume, which also exacerbates when things happen, they happen more of the fury. We'll start with the program trading. Can you talk about program trading, and did that really come into play on Monday as well?
Definitely. It comes into play. It came into play. You could actually see it on Thursday, Friday, and then Monday. It was really exacerbated. Um, you had mentioned earlier, like we're recording this on a Wednesday, and by Friday, when it may be out there, that a lot of stuff can happen. Yeah, the time frame that things happen is compressed. The information gets around a lot quicker, but then a lot of the volume of stocks, the percentage of volume that's computer traded, that's algorithm traded, that's traded by just automatic things. There's no real human involvement beyond they set the algorithms to trade at certain levels. That's gone up and up. So as stocks went down, they hit different trigger points and that accelerates the selling. And if you look at a chart closely, you can see volume spikes at certain levels, and that's those computer trading programs activated, and they go, when it hits 1%, half percent down, we're going to sell this much, then 1% will sell this much, and then so forth. So, and exacerbating that problem is, yeah, I always like to say the professionals are not at their desks right now. They're getting in their last vacations, school starting soon. They're in the Hamptons, they're wherever. They're at the Olympics. Who knows where they are, but there's not as much volume and there's not as much. You're not going to have a junior analyst that's still slaving away at the desk override those computer programs where the senior manager might be able to because he recognizes it's not a huge problem. So
Right.
just let those run. And then you watch for the follow on after that first day when things can settle down a little bit and see what happens.
You know what this reminds me of? Well, first of all, you reference it had the smell of Black Monday in 1987. This also reminds me a little bit of the Friday when Brexit was announced. And I don't know when that was, 2017 ish, that they announced on Friday Brexit. The markets just got smoked worldwide, including the United States. And I looked at it and I'm like, well, wait a minute. Let's allow cooler heads to prevail, because that vote was nothing more than a referendum. They didn't actually vote on anything for another year or two, of which it still wouldn't take effect for years down the pike. So it strikes me as this was an event that had nothing to do with the economy. But what I would like to do is pick that up. We're going to take a break at the moment. We'll pick that up on the second half of this. We'll talk about an event versus the economy. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. Here, thank you again with Brad Sorensen, Chartered Financial Analyst, CFA from Cornerstone Research or Portfolio Research. So, talk about event versus what's going on. And I know I want to throw up this one slide that you produced. So this is what happened that night, or shall I say that Monday on August 5th. You know, we saw, it says Asia, but it was really Japan just took it in the shorts, losing 12%, and that all other markets around the world also got beat up. You could see that Europe anywhere between 1.5% and 2%, and the U.S. between 2 and 3.5%. Like to throw that back onto your plate. Talk about the difference between the event and what's kind of going on.
Yeah, sure. Yeah, you can see by those that the market around the world, it wasn't isolated to Japan and it wasn't US. It was much less than Japan. That was the center. You can see that. That was the, epicenter of the earthquake that went kind of around the world. But then we ask ourselves, is this just an event that's short-lived? And you can look at the next slide I have, where the 10-year Treasury, and that shows that this was really you can see that Treasury rates had gradually declined on the 10-year. And that's in response to economic factors, that the economy is slowing, inflation is going down, economic growth is slowing, but that sharp spike down at the end, sharp dip, that's a fear-based flight to safety is what we call it. People go to treasuries because they want safe haven, and the treasury market is still the safest haven in the world viewed by investors. So they flood into there. We saw yields get down to 369, but you can see in the ensuing days, where, like I said, we're on Tuesday, the futures are up, yields are back up to close to 4%. So they're unwinding that fear. We saw a rebound yesterday. We're seeing futures up today. Investors have evaluated it, realized that the event was really just an isolated event. It's not a systemic problem. So then the focus is back on the economy. And we're realizing that, yeah, we probably needed to take a little of the froth out, but the economy is still in good shape. We had part of the economic concern, the recession talk, was what's called an ISM manufacturing survey. It's just a survey of owners of manufacturing firms and how they're feeling, basically. And that was weaker than people had expected. So that raised concern. And then the employment report also raised some concern. But then on Monday, we got the services ism, which is the bigger part of the economy. It surveys service providers. And that was better than expected. And then some earnings came out, and those were decent, and they're not falling off a cliff. And then people thought a little more about the employment report. And hey, 115 and 4.3% historically, that's still pretty good. That's not a roaring employment market, but it's still a solid labor market. And this is what we should have expected. That's what's needed for inflation to come down. So it's really a positive story that unemployment is going up a little bit, But in response to that, inflation is coming down, and that's the sweet spot that we wanted to see. That's what the Fed wanted to see. And that's what they are seeing. And that's why they've been forecasting that they can start cutting rates in September because the economy is still good. One thing we look at, and I want to mention this really quick, is that the employment report on Fridays, that's the big one. It's the first Friday of every month. Everybody pays attention to that. That's what we call a lagging indicator. It looks in the past. Really, we don't care what happened in the past. We care about what's happening in the future. That's what stocks look for. That's what we try to forecast. That's what matters. So we look at jobless claims. That's considered the leading indicator. That happens every Thursday. And it's a measure of layoffs because if companies are getting nervous about the economy, they see it first usually, and they'll start to lay off employees first. So jobless claims will go up. That level went up to the highest level in a year, which caused some concern. But two caveats: it's still below 250, and really it has to get above 300 to really be a concern. So we're still well below that. 250 is kind of a normal number because there's just churn in the labor market all the time. And then you have to be careful in the summer because the way they do these surveys and companies work in the summer, like I live in southern Florida, for example. In the summer, nobody's here. Traffic's great. But a lot of businesses go on vacation and for a month they go to Europe or whatever. We can't go to every restaurant that we usually go to in the winter because we can't shop everywhere. And they put their employees on furlough. So they can get unemployment for a couple months. So summer tends to be a little choppy with those jobless numbers. So you want to take them, even the slight gain that we saw, 249, you want to take that with a grain of salt because that's why we look more at the 4 week average because these week to week numbers can vary. And then, especially in late July and through the mid August, they are traditionally very volatile because of all these things going on with vacations and summer sabbaticals and school back in and all of those things. It can get a little choppy. So the 4 week moving average is still around 230, which is very good. So all the signs that we see show that the economy, based on the data, still looks very strong. And we've seen that investors are realizing that as they get back in and recoup the losses from Monday on Tuesday and now so far on Wednesday.
So for the sake of the viewer, I know what you're talking about when you're saying 200 and 230 and 250. What that means is that how many people have filed for unemployment last week? Okay, 200,000, 250,000, or in the case that we were talking about, I think it was 100 and then jobs added the prior month, and it was 114,000, which was less than what they were expecting. However, that is an indicator. That's the past, to your point. And leading is layoffs. Layoffs are a leading indicator. However, the problem is that they pointed out, they said, well, the hurricane really didn't have anything to do with it, but they're also saying, but the hurricane had something to do with it. Hurricane Beryl. Yeah. So that throws a wrench into gears, to your point also, as well as the summer months. And there's just a lot of stuff with the data. Then you referenced 4.3. 4.3 is the unemployment rate. And we were running at 4.3%. We were actually running under 4. And I believe they consider full employment at a 4% unemployment rate. Is that correct, or is it even higher?
Well, it's interesting. It's come down. It used to be about 5 to 5.5% was what they considered, because people that have just tuned in the last decade think that normal is 3.5 to 4. Normal was 5.5 to 6 for years and years. So they thought like the lowest employment could get without causing inflation was somewhere around the 5% range. They have adjusted that now. They think they can 4.5% is really, so they're just a little below what they would consider the natural non-inflation inducing employment range. So we're still below that.
So that's kind of funny because, it's the recency bias. So we're so used to seeing under 4% unemployment, and then it goes from 4 to 4.3, and everybody's panicking when in fact the reality of it is that it's well below the long-term trend. Same goes with interest rates. I got spoiled with 2.5% mortgage, okay, and now all of a sudden mortgages are 7% and people are panicking and freaking out when in fact that's probably below the long-term average. So things are coming back to normal again, so to speak.
Exactly. We've had, if you just think about the last, since 2008, we had the financial crisis, then we had that lasted a long time, real estate, then we had another crisis, then we had COVID. So we've been in this extraordinary financial situations for going on 15 to 20 years. So there's going to be some bumps trying to get back to quote unquote normal. But that's what most investors would like to see is normal, where inflation is running at a contained level, where interest rates are there, where banks can make money and people can borrow money at a decent rate, not a free rate, and all of those things, because then there just gets to be problems when there's those low interest rates. So we want them to get back to normal. There's too much risk being taken in the market with those low interest rates. So all of this is great. We're seeing everything get back to normal. There are going to be some bumps, but so far, when you're unwinding the amount of low interest rates and stimulus that was in the market, the fact that we've been able to come through so strongly to this point is quite a credit to the policymakers at this point and the strength of the U.S. economy.
Yep. So just recently they announced that the NASDAQ hit correction territory, which basically means it has dropped 10% off its peak. The S&P 500 did not get to that point, but I know the next two slides, I swear they teach you this in CFA school, but taking a look at over the course of the last year, this slide shows how the S&P 500 has done. And before panicking that it dropped, 6-7% or something like that in the past 3 trading days, shall I say Thursday, Friday, Monday, it probably dropped like 5, possibly 6%. You want to comment on your slide that you threw together?
Yeah, this is just to put in there. Yeah, this is CFA 101, but it's also what investors should think about. You get so caught up, some investors get so caught up in the short term, which is easy nowadays with the getting alerts on your phone and the media's trying to beat everybody. So the headlines are always, are we in for a recession? They want the biggest headline grabbers. Well, if you look, we are back to, we've lost all this money. Haven't seen lows like this since, May. So really, that's not too bad. And then if you look over the last year, we're still up substantially over the past year. And that's why we preach, stocks are for the long term. There's going to be this. You mentioned Thomas, my boss. He talks about a lot that the average decline every single year is 14%. That there'll be a 14% decline, but yet the overall year average is a 9 to 10 to 11% gain. So it can be volatile in short terms, but over the long term, and that's the next slide, these dips are very, very inconsequential in the long term.
Right, and we've got charts to show it, but I love it. So like the CFA school, they always laugh and say they must teach you in CFA school that up and to the right. Everything always goes up and to the right.
Yeah, that's why I studied for 3 years and took 6-hour tests, and my wife almost left me so I could say up and to the right.
So I guess in conclusion, and correct me if I'm wrong because we're up against time here, in conclusion, what you're saying here is we experienced an event that has little to do with the economy and it caused the markets to go down. The economy is still on strong footing. However, the economy is showing signs of weakening. But to your point, lesser growth is still growth, which is consistent with inflation. Just because inflation went from 9% to 3%, it doesn't mean prices are going down. They're still going up. But the economy is still moving forward. Is that conclusion fair?
Yeah, I think that's exactly right. That's what people need to focus on. These events can happen, and we never know when they're going to happen. They're impossible to plan for sometimes. But overall, the economy is still strong. We can weather these little events without much problem.
Excellent. Brad, is there anything else you want to add before I kick you out?
No, I think I've said enough for today.
Brad, thank you very much. I appreciate your insight as we do. We meet every week and we talk about what's going on in the economy and the clients and the models and the portfolios, et cetera, et cetera. You've been a huge asset to our firm, and thank you for taking the time today. And look forward to having you on in future episodes. And thank to all of your viewers and all of my viewers and listeners. Thank you for joining us. Hope you have a wonderful day.